Right. Okay, guys. Nice to meet you all here. Thank you, everybody, for coming today. As you can see, we're going to talk about future perspective on Bitcoin and just Bitcoin. So I'm going to ask these guys. I'm going to go around the sofas here and ask each one of you to introduce yourself quickly, let everybody know what you do and who you are, and then we'll get into some discussion. So if we just work around this way.
You want to get started? Hello. Yes, so my name is Julien Bouteloup. So I've been in the space for quite a long time. I started my adventure with Bitcoin and then moved into a lot of exotic products. So Stake Capital it's an investment vehicle. We've been investing in the space for a very long time. It's also a hedge fund and quant, so we do all type of quantitative algorithmic trading, liquidations, arbitrage, market making, flash loan, all type of things, and also been involved in a lot of different other projects. Asset management with StakeDAO, Rekt News, the one that write about the space, Blackpool, it's for NFT market, and Curve Finance, which is auto market making in a space. That's it.
Hello everyone, my name is Romain Rouphael. I've been working in investment banking for a few years, and then I joined the Bitcoin space in 2016. I've been doing a few stuff, and since 2019 I've co-founded LN Markets, which is a Bitcoin trading platform, a Bitcoin derivatives trading platform built on the Bitcoin Lightning Network. So the idea is that thanks to the Lightning Network, you can do instant trading settlement, so you can trade instantly from your wallet. And yeah, that's it.
Hello, everybody. My name is Marc Zeller. I'm the head of developer relations at AAVE. AAVE is a liquidity protocol on several networks. I started on Ethereum and then deployed on layer 2s and so on and so forth. It allows people that are, for example, Bitcoin enthusiasts, bullish on Bitcoin, to not spend their Satoshi, because it's all about the time frame, as Surfin said. The market will go up, the market will go down, but if you look at a long enough time frame, Bitcoin is a bull market for the past decade. So instead of spending your Satoshi, you can use some of them as collateral to borrow liquidity and basically be short fiat through stablecoin using decentralized finance protocols such as AAVE. And I really love this panel and the opportunity to be invited here, because I spend all my time, public time, to convince no coiner of the interest of Bitcoin and crypto, but we all enthusiasts here, so it will be my opportunity to point out a few flaws in the Bitcoin system and say not everything is perfect. So that's a fun opportunity.
Hello again. Hello again. My name is Prince Philip. I work in asset manager, and as you know, I'm bullish on Bitcoin. And yeah, I think that the future of the Bitcoin market is Bitcoin. So I'll hand it back to Daniel.
Okay, yeah. So the first thing I want to talk about is this idea of DCA, dollar cost average. This is what Stack and Sat do. This is the whole ethos behind this conference. And you guys clearly are fans of trading, or staking. So I'd like to ask, why not just DCA? In your thoughts, why would you risk some of your Satoshis to try and find some yield or try and win some trades? Who wants to go with that one first?
I think we just this one. Well, I think the idea behind staking and making a yield on the asset is if the asset is being distributed over time, then if you're not capturing a percentage of this asset over time of these inflations, then you are being diluted over other people that are accumulating this asset. So staking is trying to not necessarily like make a lot of money, but to decrease the speed of the inflation, of the speed of the asset that's being diluted over time. So because Bitcoin is being mined, so a lot of more people are receiving Bitcoin, and if you not stake Bitcoin, then your portions of Bitcoin compared to the entire amount of Bitcoin being available for people to buy then increase, and then yourself not acquiring this little percent, this inflation. So if Bitcoin is going at a certain amount of inflation per year and you're not doing the same with your asset, then you're losing money. It's the same with fiat. If you leave the fiat in the bank system, and apparently the world best researcher and the economist in the world, they were saying that inflation will not go above 3%, and now they apparently said it was 18%. It's not a very fun number, so it's fine. But the idea is if you're not making 18% on your fiat, then you're losing money. Well, it's the same with staking. And yeah, that's it.
Thank you. Yeah, I guess it's all about time frame. So I guess on a long time, you know, if you have, as we said, you know, very low time preference, it's important to just stack sats whenever you can, do some kind of DCA, regular purchase, no matter the price, you know, because so this way you can smoothen your entry price. So of course it's really interesting. But now, let's say on a shorter term perspective, trading exists for a reason, and financial instruments exist for a reason. They exist because they allow people to do arbitrage, to hedge. Also, you know, to hedge future risk and to hedge short-term risk. So basically, there are two main types of derivatives, like futures and options. And, you know, they can allow people, for example, who have a large stack of Bitcoin, and maybe sometimes we feel sometimes overexposed to Bitcoin, you know, to hedge a little bit, you know, this position thanks to these instruments, you know. Plus, I guess, you know, it's also like it's also fun, you know, because in the space, yes, we're in it for the tech, for sure, you know, but it's also interesting, and a lot of people are watching the charts, following the price, and thanks to this kind of instrument, you know, they can, like, yeah, try to get an insight of, you know, how the market is going to go. So.
I'm obviously in support of DCA. I think DCA is the best strategy for 99.9% of like the population, and trading is quite the opposite. 99.9% of traders will leave money on the table on average. Obviously, we all believe we're going to be like the non-1% and outperform the markets, but when you trade, the math and probability are against you, and obviously if you do a lot of work, you are skewing the math a bit more in your favor. That being said, what is interesting about the opportunity when you venture outside of just buying a ledger, an hardware wallet, and having Bitcoin sit somewhere in cold storage, is that you can turn your Bitcoin into a productive asset by proxy. Because right now, if I buy Bitcoin and I put that on a ledger, my risk is quite low. I will not have less Bitcoin in 10 years, but I will still have the same amount of Bitcoin in 10 years. And there's a wide range of opportunities that are offered through trading, through liquidity provision, through using Bitcoin as collateral to borrow fiat, so basically short fiat through stable coins, to use those fiat to invest or to provide liquidity or to yield farm or these kind of things, that will end up with a result that with an acceptable risk, and there's a full spectrum of risk. Some are very risky and you will end up with less Bitcoin, so not the smartest thing to do. Some are less risky and you might end up with slightly more Bitcoin. And when you are a long-term investor, it's interesting to have some kind of return of that. And I have the feeling that, as Philippe said in his presentation just before, a good portfolio management has some degrees of risk. So I think some of the Bitcoin holdings should be in a ledger and do nothing. And I think it's fair to have part of this portfolio that is set to be productive?
I believe that DCA is the best and only strategy. Simply because getting into buying Bitcoin at the same time every, let's say, week, month, or even every day, over time, you will get a good entry price, a good average price. And this makes me sleep easy. I used to be trading before. I used to trade other cryptos, I'll be polite. And yeah, I lost money. I made money sometimes, but in general, probably it's not worth it. And I do believe that the reason why Bitcoin was created, or discovered, I should say as well, was to save and to look forward to a brighter future and to focus on other things in life than just make money with other financial instruments. So I think that Bitcoin is more than just trading and more than just the market. Bitcoin is life, and Bitcoin is about prospering in other parts of life.
1, 2. Yeah. Okay, we're working. Okay. I'm gonna have to agree. I think DCA is the best and the only way. Staking the world's best asset that's ever been discovered seems kind of crazy, but what people also have to understand is when they're staking the Bitcoin or they're trading it, where is that Bitcoin going? How is it remaining safe? We've seen in the last couple of months, obviously Celsius being the poster child of, and since as well, another firm called HODL Naught, not the hodler Naught, not the space cat, but HODL Naught has also locked up people's funds. So how can we be sure if we're staking our Bitcoin that to a third party that one, it's not going to be lost, or two, hacked or stolen?
That's a very interesting question, and it's all about decentralization. So basically, if you put your Bitcoin on Celsius or Ordonode or those companies, because they are truly companies, that's the point of being centralized, there's a very high probability you will not see your Bitcoin again, because those companies are insolvent, in liquidation at this point, and you will see some money back, but probably not everything you put there back. And there's also an infrastructure issue with Bitcoin, in the sense that Bitcoin is designed to be simple and very efficient, and it's the most efficient network in the world to do that. But some design choice has been done in the past, notably in 2014, to not change the architecture of Bitcoin to allow true layer 2s on top of Bitcoin. So we have state challenge through Lightning Network. It works. It's very interesting. But we do not have the capabilities to create representation of Bitcoin outside of Bitcoin, or the other way around, representation of all the assets directly on the layer 1 of Bitcoin. It's evolving. There's a lot of stuff that is happening, but right now, if you want Bitcoin, for example, on AAVE, you have to trust a centralized custodian called BitGo. There's been like BIP done on the Bitcoin side like years ago to say, we do want a decentralized, trustless way to have Bitcoin representation outside of the Bitcoin network. That was met with strong resistance for some reason that we can accept or think it's not the most efficient, or one can have his own opinion on that. But that means that if you want to put your Bitcoin at work, you will have to trust centralized party at this point, because if you deposit some Bitcoin on AAVE, even with everything that happened, you have not lost your Bitcoin. You can withdraw your WBTC, send that to BitGo, and have true Bitcoin on the Bitcoin network. Because AAVE is a decentralized protocol using smart contract, and there's no way to be insolvent with the design of the architecture of the protocol. Obviously, bad things can happen, but recent history shown that it's more resilient. DeFi is more resilient than CeFi. Decentralized finance is more resilient than centralized finance, but you still have this point of centralization that is BitGo. And that's a debate that is running since years in the industry. Or Bitcoin should evolve or not. Right now it's not evolving, and there's good reason to believe that it's a good thing to allow true decentralization to put Bitcoin network outside of the Bitcoin network layer one.
I think if we're talking about staking, we're talking about getting a yield, in fact, on your Bitcoin, okay? And if you want a yield, we often say in finance there's no free lunch, okay? So you cannot do this risk-free, so you always take a risk, okay? And I think we have two types of risk that we're talking about. We're talking about risk in trusting a centralized entity, okay? And we've seen throughout the history of Bitcoin, MTGOX, etc., or more recently, we've seen that it's risky, but it's also risky, you know, to go through a decentralized exchange or this kind of DeFi protocol. There's also risk embedded. It's a different type of risk because the code is public, but most people, you know, do not audit the code, do not know if there's, you know, some bug or malfunction in the code, and there's been, you know, a lot of incidents going through that, and there's also the risk that, you know, your funds could be stolen in a lot of ways. So what I mean is that whenever you want yield, there's going to be risk involved. So I think it's too early to say that one solution is better than the other. What has been impressive, I guess, for DeFi is that recently, you know, throughout this chaos, we've seen like liquidation on protocol like AAVE, Compound, etc., functioning very properly, which is impressive. But it's really early, you know, to think if or to assess if one is less risky than the other, in my opinion.
Yeah, I think through the pipeline of using cryptocurrency, you have multiple different aspects of risk, and it's a matter of measuring the risk and what you are. What's your appetite to risk? For example, we say not your key, not your crypto, but by saying that you also like have major risk. Like you have the ledger store at your place, someone come to your place, kidnap, hijack, put a gun on your head. I'm pretty sure you will give your ledger. So the risk is measuring the risk between the centralized infrastructure, centralized exchange, such as Kraken, Mt. Gox back in the old days, like me. And storing your asset on your own system because you believe that you are stronger than a centralized system or any surveillance, or because you are super bullish on that blockchain. But the point is, I know Marc mentioned, when you say BitGo, are you saying like BitGo is the blockchain that is custodial? So you're saying like Ethereum is the one storing the Bitcoin on AAVE? Yeah. So here again, like in AAVE, because Marc mentioned BitGo, but BitGo is just the one that withdraw your asset, Bitcoin, back to the protocol. But then how you use AAVE and Bitcoin is because using Ethereum smart contract. So the risk here is, again, the system. So either using a ledger, you're using a ledger plus something else that is also adding in another layer of risk, and you have to measure this risk. But yeah, to the supply chain, the pipeline, you have multiple aspects of risk, and it's you measuring the risk. Either you stay vanilla Bitcoin and you keep your Bitcoin and you just wait. Say, looking at the chart, it will go 10x, 20x if you are into trading. If you value more the vision and you're saying that Bitcoin shouldn't be used for trading, but for life and other type of drugs, then maybe it's better. Or you can just go into multiple different way of staking and using different way of risk. And this is your appetite and how you measure risk in your life, I would say. Is bullish Bitcoin?
Yeah, of course. I'm gonna have to push back and ask the classic meme question: where does the yield come from?
I can answer that. So on AAVE, the answer is like very, very clear. And because we are decentralized, open source, and it's on a public ledger that anybody can have a copy of, everything is auditable. So the yield comes from people that will borrow Bitcoin to use it, or will borrow assets and think, and that's the whole point of finance, when you borrow, you think that the value of what you borrow will go down, or what you will do with the asset that you borrow will overperform the interest rate. So some people are right, some people are wrong, that's finance, but they pay to use the liquidity. So there's no magic money, there's no creation of thin air, it's true actual economic activity. That actual economic activity on average generates $500,000 per day. That's more than what people are paying for using the Bitcoin blockchain every day. It's like 300K per day, the transaction fee. Thanks to Lightning. And I think that's one of the points of the panel. Thanks for the opportunity. Is that, in exactly 10 years, like Satoshi Nakamoto was very clear, there's 64 halving. So the block reward, the subsidy, like Bitcoin is a subsidized network through monetary creation, like creation of new coins. And the whole idea is that at some point, true economic activity will compensate for the subsidy that will stop. And that's not a question for, like a lot of Bitcoiners are like, yeah, it's 2,140, we have a century. No, in 10 years, it's less than 1 Bitcoin. Like the subsidy, they are collapsing fast. And right now, the true actually economic activity on Bitcoin is not enough to support the current hash rate. And what's going to happen then? Because
it hasn't broken yet.
Yeah, of course. And one thing I'm completely sure is that no matter what happened, if you like Bitcoin, if you love Bitcoin, if you're British, if you're bearish, in an average of 10 minutes, that's going to be a new block. But it will work. Bitcoin will work. That's what's going to be the situation in 10 years when the subsidy will decline fast.
Yeah, I don't think people are sleeping on it actually on Bitcoin. I think there are a lot of people who think that this is a question that needs to be asked. And I think people are thinking about it because we mentioned Lightning Network, for example. So it's a scaling solution for Bitcoin, and thanks to Lightning, we've seen that fees have dropped dramatically on the Bitcoin network on average. So it's cheap to make transactions on the layer 1. But there's also the counter effect, which is how will miners make money in the end? So I think it's very interesting questions, very fair question to ask. Yes, we have. I think we have some time to think about that. And Bitcoin philosophy is more, to address this problem slowly, to think about it thoroughly, to come up with a solution. And I think we all love Bitcoin here, and I think that's what we love, about Bitcoin, is that it takes time to evolve.
So coming back to your question about yield, you have different aspect of yield. So first, the yield that you can get in any blockchain like Bitcoin is the inflation. First you mine. You provide computing power to the network, and this is how you can capture the distribution. It's like this is not the mechanism, the economical mechanism behind Bitcoin or any other blockchain. It's not like a novel idea. It's basically a copy of the financial system, decentralized bank, the Fed printing cash, distributing the cash to the private banking, and private banking buying the cash as a special discount or bonds or whatever, and distributing this cash to the retail, to the people that need the cash through mortgage and loan and whatever. So this mechanism exists in Bitcoin the way that you access, instead of being a private banking, then you mine, you provide value, you provide hardware security system to capture that value. So the pipeline is exactly the same. And then you have mechanism as Marc is working for AAVE, which is a lending platform. People providing asset, they bullish on certain asset, and they borrow capital. And this is providing the yield. And this is a yield lending market. So you get the yield because people are looking to borrow some asset that you lend there. And yourself, you don't want to sell because you believe the asset will go higher than the one you're borrowing. You can short, long, whatever. It's like trading. And then you have a mechanism like Curve, auto market making, or LN market, like platform that will provide fee or spread. I mean, people will make money on the spread in centralized exchanges or decentralized exchanges, like LN market. It's market maker capturing this yield, this spread. In decentralized platforms such as Curve, is people providing liquidity because the entire profits distribute back to the people providing liquidity. This is how we size the yield. If you go to Curve, StakeDAO, you have the yield, and the yield is proportionally calculated compared to the activity you have in that pool. So you have multiple different ways. You have trading, lending, market, you have liquidations, you have flash loan, all those different types of things. Then this is distributed back to the strategy that you are providing liquidity to. This is one way. Yeah.
Yeah, and maybe, about the question, where does the yield come from? I guess, I was asking myself this question, about like all these platforms, offering like 8%, all these centralized platform offering like 8%, 20%, 40% on your money. And I think this were the real dangers, much more than DeFi or this open protocol, because with this platform, actually, I had a lot of friends, or I teach to students, a lot of students saying me, hey, I can get like 25% on my stable coin thanks to this platform, I have a debit card, it's awesome, etc. And I was just asking, okay, so where does the yield come from? I have no idea, I don't care, okay, I just want to earn 20% on a stable coin. Yeah, until it all collapsed, because they're all doing the same trade, okay, which was like, there were multiple trades, like the BTC arbitrage, and then the 20% anchor protocol. And when they all collapsed, you realize they were all doing the same trade, okay, getting 20% on Luna, which is completely mad, when you think about it.
Do you want to?
Hello? No. I was also very curious about where the yield comes from, and I was hoping that someone maybe like SBF, Samuel Bankman-Fried, would answer that question correctly. And then in a recent interview, he actually described yield farming as a Ponzi scheme. So I don't know, that doesn't really instill a lot of confidence that one of the highest priests of shitcoinery doesn't know how to describe yield farming and where it comes from. So really, I think we're overcomplicating things in the so-called crypto market. Sorry, that's my point.
Just the last point about yield is that if someone gives you 20% and say it's guaranteed on your fiat or on your stable coins, there's probably like something shady going on. And I think recent history prove it. And when Celsius was saying like 8% when all decentralized finance market were paying 2%, you say, where does the money come from? And that's all about, when you think about yield, you have to consider that if it's true actual economic activity, it cannot be like 20 or 25%, because who's going to pay that to support the thing? So yeah, on AAVE, on your USDC, for example, you would get 2% right now, because that's the true actual economic activity right now. The market says that there's no magic money. So yeah, it's less sexy than Encore, but I think people lost less money on AAVE than on Encore, like quite a bit. And also, I want to remind people that sometimes the yield, the percentage is low, but for example, on Bitcoin, you will be happy to get 0.5% of your Bitcoin, because that's what the market pays. But when you have Bitcoin on your ledger, your yield is effectively zero. And will you, in the room, take a deal, like if I give you 2 deals for the same amount of money, if you have $10,000, you can buy $10,000 of Bitcoin and you will get a 0.5% yield on that Bitcoin, and you cannot touch the Bitcoin for 10 years. Or you have $10,000 of USDC and I will pay you 3% on your USDC for 10 years. And what's the better deal? The first one. Because the interest rate is higher, well, the yield is higher on the second one, but the second one is fiat. What's going to be the purchasing power of that fiat in 10 years? I think the purchasing power, even if the yield is lower on Bitcoin, is better, and it's a better deal.
Low, yeah. There's also another type of yield that is being available over the past few months or a year now. It's lobbying. Because all those different products are getting connected to each other, if you have, I mean, especially in DeFi, if you have access to those assets, you can vote in certain ways that will advantage or disadvantage other protocols. For example, on AAVE, on Curve, on StakeDAO, you have different way of, we incentivize people to vote because by voting you can say, okay, we'll redirect the inflations in a certain way. So for example, redirecting the inflation, if you're a miner and you receive Bitcoin for providing security hardware to the protocol, we can say that the entire inflation of that Bitcoin will go in the certain pool. So that's why, for example, in StakeDAO we provide, I think it's like 2 or 3 times more APY than AAVE. The reason for that is because we are plugged on top of AAVE and we also plug on top of Curve, which is an auto market maker plus a lending market. So both we add better yield, but this yield is intrinsic value. This yield is from protocol of Bitcoin and protocol of the auto market maker and protocol of the lending market. So they are intrinsic value in the sense that you get value from trading, you get value from lending market, and you get value for providing security hardware to the protocol. So it's like intrinsic value. And I think what Philippe said about SBF saying that yield farming was a scam, I think this is out of context. I think, yeah, 99% of all the yield farming projects were scammed because this is how world works. You have people building technology to scam others, and you have 1% that will always make the best and brilliant solutions. I think what SBF mentioned is that the opportunity of not getting involved in yield farming, because yield farming is being built by scammers and they have a lot of potential of making money, then this is actually a hot space in the sense that it will make a lot of money because those platforms, they're not providing any value. What they do, they send a huge inflation of their token inside the pool, and they believe that people, by joining the pool, they will buy the asset. So it's a matter of when do you sell the asset to the other. It's called a Ponzi scheme. So what SBF said is the opportunity of trading in that specific technology is huge because a lot of people are building things that are not made for the visions, for revolutioning the market. Yeah, it's true. But the rest is 1%. It's the same with any industrial revolution. Internet, 1% made it. 99% were all scam. They all disappear, we'd never heard of them. But then you had Google, Facebook, Yahoo, and all those guys. It's the same today. 1% of people building will make the future, and the 99% will try to scam others. It's always like this, it's human.
Yeah, I think that's what also is, or has been maybe so confusing about DeFi. I think it's less the case now that we're in a bear market, but for a few months, or last summer, for example, you also had these crazy yields on regular DeFi protocol, like this 20, 40%, etc. Because you had, also you had a lot of new tokens that were launched by VC, and that were pumped really high, and it's exactly what SBF mentioned, Yeah, maybe, but what I mean is that a lot of people, and you have the same question, I mentioned SEX, but our centralized exchange, yield, and where does it come from? You had this question on decentralized protocol as well for a lot of time.
Well, not really, because in decentralized protocol, you can always know where the yield comes from. On centralized exchanges, no. And like, for example, what happened with those guys, what's called 3 Capital, Celsius, what they did, they lend assets on a specific platform, they borrow against, they got the capital, and then they want to see a traditional finance. They say, okay, we have that much of capital, can you give us a loan? Then they give us a loan, and then they want to centralize places like Celsius and provide the money. The only thing that you don't have access to the order book, you don't have access to the paper that's saying where the money comes from. Centralized DeFi, or blockchain, if you want, you can know. If you don't know, it's because you don't want to know. But you can always audit the transaction, always audit where the yield come from. So saying that you don't know where the yield come from is because you're lazy, you don't want to know, or you don't have access to this knowledge, or you don't want to just search on the internet where the yield come from. But in decentralized finance or blockchain, you can always know. In centralized products, you don't know.
Sorry, I understand that you guys, and I respect that you guys are the 1% that are doing things correctly, but given the other
I consider myself being the 1%, and I consider myself also a Bitcoin bullish guy.
Of course. I know, I understand that. But what I was trying to get at is that Bitcoin was designed not to stop scamming humanity, and I think that we're overcomplicating, and I said it before, that we're overcomplicating markets by creating new instruments on top of that. I understand what, the need for yield, for making money, but I really think that the future of the crypto or Bitcoin markets is that the money has been created, and we can focus on other productive areas of life. We can focus on starting more jobs and starting, I don't know, just real hard work again. I mean,
well, how to say that? Well, first, we don't know what Bitcoin was designed for. I mean, you have a light paper. We're all making interpretation of this paper. If you know Satoshi, please, we can have a discussion after. I would like to know. But I was in Bitcoin very early, like 2010. And then I had Mt. Gox story, I had all different things. My point, yes, we want a technology to serve the people in the future of this humanity. That's what we all want. You cannot stop someone from buying a knife and instead of cutting the piece of meat, killing someone. This is called freedom. The thing is, in Bitcoin, I mean, what I want to say is that the technology trading is just an aspect of a technology. But saying that people in somewhere in the world won't use Bitcoin to buy some guns or to do some other things is the same. It's just an aspect of the technology. Saying that trading is bad because it's not in the vision of that technology, no, it's not true. Trading, exchanges, using the technology in a certain way is providing value back to this technology. It's a matter of how we incentivize people to provide the best. We incentivize people to use this technology in a certain way that will not impact or harm people. This is the beautiful aspect behind building future of technology. But saying that this technology is not, I think we shouldn't do trading because trading is bad, as bad aspect and making people money. We should just keep Bitcoin and put it on our bed and sleep on it. I think this is not correct, because this is not how you make visions of this world evolve and people participating in this technology. If you make everyone maximalist, what we should be is maximalists of the vision, maximalists of the technology. But then as long as the technology is serving a purpose of helping this world and society, then I think we should all be happy. But this way of saying, no, don't do that because it's not what it's made for. We don't know. It's made to serve people and serve the community in the future. And incentivizing people to use this technology in a certain way, then this is our job. I mean, that's what I truly believe.
I mean, good response. I would just say that, I don't know, I just feel that trading is just going back to the fiat system, and it's just going to creating more financial instruments and going back.
But trading is the origin of human life.
But
trading is not an exchange market. Trading is trading value. I have a car, you have a ship. Mm-hmm. You need, I need something for the winter, and you need something to eat. So you use the milk and I use the stuff on the ship. And trading exchanges is exchanges of value. And in Bitcoin, you can exchange value. You can give Bitcoin to someone to eat. You can give Bitcoin to someone to buy gas. There's a
difference here. That was a need. What you guys are doing is speculative.
It's not because if you don't have trading, you don't have technology. If you don't have trading, the fact of having trading it's basically bringing the if you don't have trading, you cannot buy and you cannot sell. Because why would you sell something at 50% discount or a slippage, what we call slippage, or like a huge spread? Trading bring the healthy market.
It brings commission to people.
No, it's not. No. The more trading you have, the more arbitrage you have, the less commission you have for people, because the market is more healthy. And you have more actors. That's it. This is not true. The reality of trading is the more trading you have, the more, first, the more security you have in a protocol, the less commission you have for people, because you have more actors, because the market is more healthy. So without trading, you don't have any technology. You don't have finance, you don't have exchange, you don't have technology. No one, if you don't have trading, you cannot buy mining. Like ATI, Radeon, or NVIDIA back then, now like all those type of hardware that provide security. If you don't have trading, you cannot buy them, because no one wants to buy something that you cannot trade.
I still think we need to like define trading and speculation, because what you guys are talking about is speculative. Trading something for another thing, a need or a want, is thank you. So this is what I think Philip and I are on the side of the fence of: do not speculate with your Bitcoin.
I think, well, as Julien said, when you do your DCA, because you are an investor and what's the difference between a speculator, a trader, and an investor? Most of the time, it's just the time frame. Like the speculator expects a return on investment in the short term, an investor is here for the long term. But both are expecting to gain purchasing power over time. That's the second thing. You can love finance, you can hate finance. What is interesting is to look at the system. So when you do your DCA, because there's liquidity provider, because there's market makers, you don't get a bad deal, as Julien said, to have 10% or more slippage. You buy the fair price of Bitcoin at any point because there's someone on the other side that is basically providing liquidity. There's a value in that. Does that value is worth everything? Does it super efficient? Whatever, that's philosophy, and I will stick to data and the system itself. What is interesting is that I will get another example that maybe will have some kind of consensus of something we may not love and share, like profile picture NFT on Ethereum. I'm not very interested in that. Like, to be honest, like paying $500,000 to have a ape picture on the blockchain, it's not very interesting to me. And maybe it's not very interesting to a lot of people in the room. But profile, the what? Yeah, but profile picture NFT paid dozens of millions of dollars of transaction fee on Ethereum this year. So I don't like it personally. I don't buy it personally, but it's securing the Ethereum network because miners providing security to the network are paid through transaction fee of this activity. And I'm not here to judge. When you build a network, when you have a blockchain, it's really important to stay permissionless and to stay neutral. You want to do shit, do it, but pay your transaction fee. Pay your fair share to contribute to the network. And all this activity on other networks that allows a wide range of use case led to the situation we are right now. Every day on Bitcoin, there's $300,000 paid to secure the network, to make sure that the blockchain is secure. On Ethereum, it's $2 million per day. So one network still has to rely on subsidy, as we said earlier, the block rewards, and the other one will cut 90% of the subsidy in 2.5 weeks. And I wish the best for Bitcoin. Like, I think we all Bitcoiners here. It's a spectrum. Like, some are more Bitcoin only and so are open to other opportunities. But we all want Bitcoin to thrive. And for Bitcoin to thrive, when the subsidy will decline eventually, you need actual economical activity. And speculation is economical activity. When you use Lightning Network market on Lightning Network, you contribute to the Bitcoin network, you contribute to the Lightning Network, and when people close their channel, it's a transaction fee on the layer one, and you're contributing to the Bitcoin network.
Yeah, it's a good point that you said earlier. We need to define trading. I mean, for the audience, I would say that trading is not for retail, and you shouldn't be trading. Trading is a day job. It's 7 days a week, especially in blockchain industry, 24 hours a day. If you involve and go into trading, it's 99.999% of very likely that you will lose money. Because it's a job. You need to understand the concept, you need to understand that someone is playing against you, that someone is playing with you, like all the different things. So trading is really not for retail. That was my point. Like, as a retail user, you should always protect yourself and always limit and decrease your risk. So trading is not. But the concept of trading and the concept of changes, why would you buy Bitcoin today if you don't believe in trading or in exchanges? Because it's exactly the reason why you will get Bitcoin. You believe that in the future, this asset class will outperform other. So you're a trader. You're trading, but you don't want to be professional trader to say, oh, because you're in speculation. No, you guys are the worst. You guys are even bigger speculator than the trader, because traders are short-term manipulator of the market. They don't believe in the vision. You are believing in the vision and speculating on the vision. So you are bigger than those traders. You are like trader. That's the point. So my point is like, don't get yourself involved in trading because it's very dangerous and it's a job. But yeah, get into the asset if you believe in the vision, if you believe that this asset will outperform others. So you're a speculator and a trader. And you will be able to use this asset to unlock specific feature in the future.
Yeah, I don't think trading is bad. The same way as I don't think financial markets are bad, because I think they're very important for economic activities. They've been invented for a reason. So of course they could work better, they could be more efficient, they could be more regulated. There's a lot of things to improve, but they're here for a reason. And I would say we want Bitcoin to succeed as money. Okay? And I think that for Bitcoin to succeed as money, we need the Lightning Network to scale, to have more users, to have more people aware of it, using it to build better tools. And I'm very proud of something, which is that, for example, with LN Markets, we got something like 20,000 users all around the globe, and it's people, a lot of them found out about Lightning, trading on our platform, and they just said, oh my God, okay, thanks to that, you can exchange value instantly. So maybe, okay, I was just here for fun, for speculating or whatever, but now I realize that I can move money all around the globe instantly, okay? So in fact, just, being a degen for, for a few times on the platform, then you learn the power of instant transactions, without any counterparty risk, censorship resistant, all around the world. And I think it's priceless.
Well, I agree with that, and high five to Romain. I think he's one of the actors that is really pushing Bitcoin towards, the vision of Bitcoin, what is Bitcoin. And yeah, I think that the problem in the blockchain without people like Romain and the LN market, it's the protocol gets into a state of chaos and not evolve compared to what is being available in the industry. And I don't believe that saying and keeping Bitcoin as it is now, as the art of, it will make Bitcoin the future of a commodity, for example, like money. Because it's very tough. Like you have the world is evolving very fast, and you have. I would say that Bitcoin will have been, and probably the only technology if there were in a world there was no internet, or a world where there would be no technology, because then it would make sense for Bitcoin, for example, as gold, digital gold or digital money, and that's it. But now you have other competitors, you have other technology that are pushing the boundaries thanks to mathematics and science. And we cannot ignore them. So what Romain is doing with LN Market and making sure that we can transfer this asset over time without cheap cost and faster, I think this is really very big.
Okay, we've been talking a lot about this in the sense of retail. And recently we've had big announcements, JP Morgan making noise, BlackRock making noise about entering the market. And with that will become a lot of pushback against the existing smaller guys in the market. This is what fiat conglomerates do. And they will bring the regulations in that they want to see, because they are monopolies and we know how they work. How are you guys envisioning that? Philip, you might have an inside scoop on what BlackRock or JP Morgan or people like that might be doing And how do you think that the wider financial market, the legacy financial system, is going to look at regulations, and will they come after companies like what these guys have started building to try and regulate them out of existence? And then we'll kick it over to you guys and see what your thoughts are on that.
I like what Fidelity's doing. They've actually wrote, earlier this year, they wrote a paper actually differentiating Bitcoin from the rest of crypto, which was quite interesting. So in terms of the asset management space, Fidelity is quite ahead of the others. But as we recently learned, yeah, as you mentioned, BlackRock and another big heavyweights in the asset management space are now providing Bitcoin, which I think it's great. It's part of the journey of Bitcoin. Regulations is a big issue that we all care about. As I spoke about before in my talk, that Bitcoin shouldn't really be regulated, because essentially, the essence of Bitcoin is that it's text, it's information, it's mass. You can't really regulate that. That's just regulating. How do you regulate free speech, essentially? But we're not quite there yet. So I think it's important that if jurisdictions want to move forward with this this is the fastest growing space in the world. I'm not talking just about Bitcoin, but I'm talking about other cryptos as well. Is that they have to embrace good laws, zero capital gains, those sort of laws, and I think that's where the innovation, the money will come in, the people will go there. That's where the future is really for the crypto markets, for the Bitcoin markets, and with that comes along more education about what Bitcoin really is. And I know we have our differences here, but I'm glad that everyone on this panel here is very into Bitcoin, and they see the future of Bitcoin. We have different perspectives, but at the end of the day, I think that if we do make new laws on Bitcoin and cryptos, I think that there will be we should have to separate exactly Bitcoin from crypto, from the other cryptos, because Bitcoin doesn't really have. We don't know who the creator is. I mean, I don't know who Satoshi is, so. It may be in the room, whereas the other cryptos out there are they have CEOs, they have marketing teams, they have people working on it, and so really they're unregulated securities, and I think they should have tougher regulations. Whereas Bitcoin really is an open system for everyone to use. Everyone can work on it, and it benefits everyone. So, thank you.
Guys, thoughts on regulation?
Just before on. I think people don't really realize, because we are talking about the big guys entering the crypto asset markets, is that Bitcoin is probably the first and likely only, because the other crypto asset has investors, VCs, ICOs, and things like that. Bitcoin is probably the first and only asset in the world in financial history where the small guys, the retails, had absolute priority on the big guys. If you bought Bitcoin, like until now, basically, you had priority and you front ran like BlackRock. Because the first time I bought Bitcoin, it was a small amount in front of a restaurant in the street, and I gave some cash to a shady guy that gave me like some Satoshis. And BlackRock will not do that, like clearly, and the liquidity was not there for this kind of big guys. The framework and the exchange were not there for this kind of guys. So Bitcoin offered to the regular guy, the average Joe, 10 years of exclusivity to access the asset compared to the big guys. And I think it's incredible. Like, it's an opportunity that never really exists before, because when you are a retail and investors, you are usually the VC exit liquidity, because you can access the market when you are not a credited investor, when the assets reach the public market. So after the seed round, the Series A, B, C, and all the alphabet, and you basically buy the bags of the investors. Bitcoin, it's the complete opposite, and I think it's the only opportunity we ever gonna have in financial history as small guys to be served and have the opportunity before everybody else.
Yes. Yeah, and you know what's interesting also, I guess, from an institutional adoption perspective of Bitcoin is that my friends who work at private banks, and I do some talks in like private banks, and it's interesting because it's something where the top management says, okay, we don't want to hear about Bitcoin, but it's a request not of the clients, but of the clients' daughters and sons. Okay, what they call the next generation. And they're like, okay, look, we look like total boomers when we talk to them, okay, because we don't know, or we think it's bad, or we think it's not good, Bitcoin. ETH, NFTs, whatever, etc. And now we have to, okay, otherwise we're going to be out of the competition. So I think it's not only like for retail people, you know, and I completely agree, you know, it's the first time in history where you could be 10 years ahead the big guys in finance, and also for, it's interesting to see that it's a grassroots movement from the young, and I think it's really powerful. But I'm also concerned, like, about Bitcoin mainstream or institutional adoption. I'm also concerned about having like two kinds of Bitcoin in a way. One Bitcoin which is about decentralization, which is about censorship resistance, which is about the freedom to transact the way you want, and a Bitcoin that's going to be Wall Street Bitcoin, because that's going to be much more regulated, that's going to be made compliant, and that's going to be packaged like any other financial instrument. And I think this could have detrimental effects on Bitcoin that are often under-assessed or underestimated.
Well, first, coming back to the fact that Bitcoin is probably the only technology in the world where VC will never be able to touch in the early days. Well, the reality, like, I like the message about, it's an unknown person, so Satoshi Nakamoto that created Bitcoin, but then we crossed the bridge a little bit too quick, because since we don't know who's this guy, and this guy had 1.12 million Bitcoin, which is probably maybe not much for you, but 55 billion US dollars, and we don't know the guy, maybe the guy is a VC, so maybe it's not true, you see? You cannot say in one side we don't know and in the other side we know. So my point is, yeah, it's a beautiful story and I love it, but we don't know what we don't know. So that's one thing. And the second point, I'm quite bullish on the concept of regulations, and I'm really in favor of regulation. I think without regulation we have chaos, and in this world we've seen it in the world of blockchain and DeFi, that if you let people do whatever they want, then we end up on the leaderboard of Rekt, and a lot of scams, as Philip said. Yield farming is a scam, and yield farming is a scam. It's a Ponzi, which I think it's true in most of the case. So regulation is nice, and that's the only thing in regulation. What we'll need to do in this new type and new paradigm, new industrial revolution, is the new way of thinking. How can we regulate something that has no borders, that can be exchanged in the world in instant matter? This is really what we're looking for. People that are able to regulate for the safety net of others to be used, and at the same time to let people innovate. So regulators that are here to add a nest against innovation is perfect, but not regulators that are here to innovate, which is dangerous. So I think in regulation we all need them to jump, try to understand, and if they are user, then they will also understand what the power of Bitcoin, the power of this decentralization, and why this society needs such a form of commodity to make the world a better place.
Thank you. Thank you, guys. That's us done. That's 30 seconds left. So thank you for the discussion, and we'll look forward to the rest of the day. But stay humble, stack sets.